Let's get across the market open now. Kerry Craig joining us from JP Morgan. Kerry, welcome back. Great to see you again. Let's start with what we're seeing on markets at the moment. We're pretty much everywhere you look, records are tumbling. What are you seeing at the moment? What's actually driving all of this?
Well, I think it's a pretty simple formula when we look at what's happened across the course of this year. That's really been that you've had easy monetary policy, economies that continue to move away from a recessionary risk, and corporate earnings that have supported what has been rising valuation. So the markets have continued to go up. Within that, a period of consolidation is not unusual. So a little bit of profit taking off some things that have done well would be pretty normal, but should be in the context of what has become a much broader and longer rally for equities around the world.
When we take a look at what's going on with central bank policy, that's clearly boosting sentiment as well. Are you seeing that likely, with the prospect of further rate cuts to come in the States, are you seeing then that that's going to be broadly supportive for both equities and also corporate credit?
Well, I think so. It's a little bit of a divergence happening now around the world. If we look at the Federal Reserve compared to other central banks, most other places, if we look at the European Central Bank or potentially here in Australia with the RBA, they're coming to the end or maybe have even stopped cutting rates in this cycle. They've already gone through that easing period where the Federal Reserve is only just really embarking on it after what's been quite a long pause, and we would expect another 100 basis points of easing from the Fed. And that is going to help. It's going to loosen financial conditions still. It's sort of erring into the side of supporting growth, even though inflation has started to creep back up a little bit. And, the market typically does well when the Federal Reserve is cutting rates. We can see that across prior rate hike cycles, and particularly so when they're cutting rates when there isn't that recession in the background. And that can mean that you get these market rallies that continue for some time. Within that, we obviously are seeing the tightness in spreads across the corporate credit sector. Again, I think that reflects the health of fundamentals in terms of the corporate fundamentals in many companies. And we would suggest that it just means that, for things like investment grade, you're getting a little bit of a pickup in terms of that spread over what you'd get on a risk-free asset. But most of it's going to come in terms of return from that income or coupon component. And we wouldn't expect spreads to tighten very little much from here. And we'd prefer to look at sort of high yield debt where, default rates in the US, about 1.4%, very low historically. No real reasons to see spreads start to widen, and you're picking up about a 7% income on that. So I think for many investors on the fixed income space, it's still about focusing on corporate debt and then a little bit of duration in terms of adding to that at the shorter end of the curve to try and barbell out that positioning across fixed income.
Kerry, I see you point out that weak US dollar is likely to be supportive for particularly emerging markets and in this part of the world as well. What are you seeing here in Australia, given it has underperformed, particularly what we've seen on Wall Street? Is that likely to continue in your view?
Yeah, it's a real challenge in Australia because the economy is actually doing pretty well if we look at the growth forecast compared to many other parts of the world. And, the RBA has effectively achieved that soft landing of the economy. Inflation is sort of back in the target band. Growth is looking pretty good. Household incomes are looking pretty resilient, and we should see consumption continue. But the market really hasn't done as well. It's still positive in year-to-date terms, but you've also seen earnings downgrades come through over the course of this year at the same time that investors have been willing to keep allocating to equities in the Australian market. And so therefore valuations have continued to move higher. So a lot of the movement up in the Australian market this year has been that re-rating rather than earnings. And that's very different to what we're seeing elsewhere in the world where you've had a bit more earnings support come through. So the valuation challenge is definitely a little bit harder here for Australian equities. And there's not much on the horizon to suggest the earnings outlook is really going to change dramatically in the near term. So it does feel like you are going to still be a market that can generate positive returns, but one that's likely to lag what you see internationally when you have earnings upgrades moving through valuations that are relatively more attractive and momentum that's building in the economy.
Kerry, if we focus on the sectors, certainly here in Australia, resources has been the outperformer most recently. What are you seeing in that space, particularly with those underlying commodity prices?
Yeah, the movement in commodity prices has been pretty remarkable, especially when it comes to some of the precious metals. And that's likely to be maintained. I think that there's a lot of momentum in those prices going up. There's a lot of reasons why we've seen, for example, gold move higher in this environment, seeming to break through forecasts for the top on a daily basis. But I think more importantly, you've seen that rotation in terms of the assets or the parts of the market that got very expensive in terms of the financials. Investors starting to look for things that were relatively more attractive, and so that rotation between financials and resources that had been sort of teased during the year but didn't really come through, starting to become a little bit more persistent overall. Elsewhere, in terms of the sector composition in the Australian market, I mean, there is going to be some support for some of the consumer discretionary side of things, given you are seeing a little bit more activity in the housing market. You are seeing, again, household incomes that are being supported, given we have that bring down in inflation. You've got still relatively tight labour market and wage growth that's still positive. And you've had the tax benefits and obviously the lower rates come through as well. So I think that would lean to more consumer names and the household housing names as well, in terms of areas you would like, and potentially the REITs market as well. So there's opportunities within Australia. I think at the index level, it's a bit more challenging and being a lot more nuanced and about allocating towards the economy that's doing well. But again, having that mindful eye on the fact that, the valuations have moved up.
More globally, Kerry, particularly when we focus on the States, it has all been about AI, and that has seen those tech stocks obviously do very well. Do you have any particular concerns there, given how heated that is?
Yeah, I mean, there's a lot of conversations at the moment with clients around just the circular nature of some of the deals that have been announced between these large hyperscalers and companies that are now sort of becoming adjacent to AI in terms of wanting to be part of that. And I think that has raised some concerns around just the size of the numbers that are being talked about in terms of that investment, and that there's going to be return on that investment. So a lot of what was fundamentally supportive around these hyperscaler names and all this investment that they were doing was the fact that they had very high cash balances that were reinvesting in themselves to, be at the leading edge of this technology, because we know that not all companies are going to win in this race. And so there was always going to be that heavy investment coming through. But since then, you've seen those capex as a share of operating cash flows start to rise. So increasingly, it looks like they're burning through those cash reserves. You've started to see companies think about allocating towards debt. And so it becomes a little bit of a different narrative if that return doesn't get delivered. So that's the risk that's coming through at the moment, that these revenues don't really start to materialize based on all this investment. I think it'll take some time for that to show up. And in the meantime, we do still very much believe in this AI secular theme that's going to play through in the market. But we'd also prefer to start thinking about not just those mega cap names, but some of the companies that will start to benefit from it in other areas. So that's the utility sector with energy, that's industrials, given some of the build out they'll do for this AI value chain, and also thinking around other parts of the market that are going to do well if the economy is improving and you have steeper yield curves, such as financials. So AI and tech is not the only game in town when it comes to the US market. I think it's important to differentiate between what's happening in the AI space and look for other ways to play that same theme, which can endure for some time.